If there's anything that the global financial meltdown of 2008 taught us, it's that risk management is important in almost any investment environment. If you don't have a strong risk management approach to investing, you could be exposed to some potentially dangerous volatility. In the investment world, while a little volatility can be good, too much of it can eat into your portfolio's returns. So this happens through something known as volatility drag or volatility drain. What it amounts to is this: with all else being equal, the more volatile your return stream is, the lower the compound rate of return you'll actually get, because it affects the way your returns compound over time. Here's an example. Let's say investor A has $100,000 and earns a 10% return over 2 years. His mean return is 10% per year, and he'll have a cumulative value of $121,000 after 2 years. But let's compare that to investor B, who also has $100,000 but earns 30% in the first year and minus 10% in the second year. This person's mean return is also 10%, but they're left with a cumulative value of $117,000. So how's that? Investor A earned a 10% rate of return, while investor B only earned actually an 8.2% rate of return. The difference came about because of volatility drag, the negative impact volatility has on returns. This is where active management becomes really important. In passive investing, you own the market, all segments of it, including expensive, high volatility, and low quality portions. But with an active approach, a manager is required to not only pay close attention to risk, but also to have the right procedures and policies in place to make sure the portfolio lines up with the investment philosophy and the goals of the client. In an ongoing oversight of the portfolio, an active approach puts a high priority on risk management, and because of this, the active manager can choose which securities or asset classes might provide better return for the risk being taken. I want to say that again: might provide a better return for the amount of risk being taken, and maybe choose not to invest in certain expensive or high volatility securities by doing so. In other words, they may reduce unwanted volatility. You've probably heard the old saying that goes something like, one of the best ways to win is to keep from losing. Well, what this also kind of means is try to lose less when the markets are heading south. At Lucia Capital Group, we discuss the impact of market volatility and show you ways to potentially reduce risk. And in the midst of a 10-year bull market, now is the time to take action. Give us a call, and you know this, we're always here to help.